All right, this is video 8 in our beginner series of properly structured whole life insurance. And in the last couple of videos, we talked about the difference between being a debtor and saver and how every decision we make has a consequence. And then we also talked about how loans work and earning interest versus paying interest. And this is just a calculator from Truth Concepts that just break down the math behind how borrowing works. And especially if you're analytical or if you're like me, that strategies and philosophies built on math help. You're going to enjoy this video, and if you're not super analytical, you may or may want to skip this video depending on if numbers scare you, because there's going to be a lot of numbers in this video. So without further ado, enjoy the video below. All right, so part 2 of this video, we're going to be looking at Truth Concepts Calculator. It's going to be a little bit numbers heavy, but this, if you're watching this, you will appreciate the numbers most likely. So this is the assumption we're making. We're making that we're assuming that you're paying $20,000 a year, even though we know that these plans are flexible, but we're assuming $20,000 a year. We're assuming that you can earn 2% every year in your account, which we're really got to compare this to like a savings account, because we're going to be using this to buy cars. We're looking at over a 30-year time period. We're assuming a 30% tax, which again could be higher or lower. And what we're going to do is we are going to be buying cars, and the cars that we're going to be buying are $65,000. Just to go back to the last video, just staying consistent. We're buying our first car in year 5. We're going to buy 5 cars throughout our life, and when we do repay them, because I'm going to show kind of the combination of all of the above, we're first of all going to pay cash. So the first thing that I want to do is I want to actually take back the cars. If you're taking notes, I want you to write down the number 749,658. So it's this number right here. So I'm going to write that down as well so that we can stay on track. I'll move my cursor so you can see that. Okay, and now that's the money that you would grow, assuming taxes, in a 2% account over the 30-year time period. Now, when we pay cash for the cars, okay, we're paying cash for the cars. Those cars are going to cost $325,000 to buy all those 5 cars. That's like the hard cost, but now our account drops to $330,000. You want to write this down: $330,000. $980, and that's a difference of, if you add this with the true cost of the cars, the difference is $93,706. That difference is lost opportunity cost. I feel like a broken record sometimes, but the fact that you're paying $65,000 here means that $65,000 is never able to grow for you ever again. This is just a 30-year time period. Imagine a greater number. So what we're going to do is we are going to bank with a savings account. Before I show you the life insurance, we're going to bank with a savings account, because you can do it, and it's not as effective, but I think it's still important to understand. So what we're going to now do is we are going to pay ourselves back at 5%. What you're going to realize is this is going to be dramatic. We're actually going to have more money than $479. You're paying yourself back at, you're paying yourself back 5%. So you take a loan, you take that money out, and now you're paying yourself back. And because you're paying yourself back at a rate that you're earning more, at the end of the day, you have $787,221. You want to write that number down. You want to write this number down right here, because you're buying 5 cars, you're paying yourself back with interest. At the end of the day, that's actually increasing your wealth over this time. So, we see the benefit of saving money. You at the end of the day, you bought five cars, you are paying yourself back, and that extra interest is going towards your bottom line. So one of the things that the annual interest cost is $11,454, and ultimately that money is going towards you. Okay, so now what we want to do is we want to include life insurance. Okay, and there's a couple different things. I'm going to load in the life insurance contract that we looked at early on, and you can see in the first couple years, it's it's different. You don't have dollar for dollar access in the first couple of years, but you can see, and we also have to turn off taxes because you don't pay taxes on the growth. You can see the dramatic difference. Instead of $749,000, you're over 1.1 million in cash value. And write this number down. It's $1,167,752. So that's the kind of money that you would have in your life insurance, just because the rate of return is greater and it's growing on a tax-free basis. Now, when you buy the cars, remember, you're not taking from yourself. Okay, you're actually borrowing against yourself. So what we're doing is we're taking, account loan, and what we're doing is we're paying the insurance company, because the insurance company is loaning us that money, and our money is continuing to grow. And so something that's really, really important to note is there interest costs associated with that? Well, absolutely. There is interest associated with that. We're paying over $41,000 worth of interest over our life, and for these cars, and at the end of the day, you're doing the same thing when you're paying cash. But when you're paying cash, you're actually paying yourself the interest. In this scenario, you're actually paying the interest to the insurance company while your money's continuing to grow. Check this out. Whether you're borrowing your money or borrowing against your money or not, your account stays the same. So if we go to the extreme example, if we're assuming you can earn 2%, we have to go back and say, okay, the number that we wrote down with our savings account is, it was something like $749,000 or something a little bit higher than that, or $787,000. That's the money that you would have if you paid your money into a savings account, used it, and paid yourself back 5%. Most people don't do that. But if you save your money into a life insurance contract, it's going to grow more efficiently throughout your life. You're going to do that same activity. Instead of paying yourself interest, you're going to pay the insurance company interest, but your money is continuing to grow the whole time, and you have, over $400,000 more money because of this equation. So just this equation alone, this example alone, you're $400,000 ahead by just understanding that the life insurance is a better place to save and use your money, even though you're paying the interest in both scenarios. So again, there's going to be other videos that use this calculator, but I wanted to just lay down the why we do what we do.
Hey, it's Caleb Williams here. I want to thank you so much for taking time out of your busy day to watch our YouTube videos. We put a lot of time and energy into making them informational and helpful. I also want you to know that we do this for a living. So if you're an advisor, an agent, and want to learn more about the and asset and how to incorporate this into your life, check us out at theandasset.com. Also, if you're a consumer, if you're someone that wants to learn more about the and asset in your business or in your retirement plan or in your life, and asking questions like, would this be beneficial to me? We want to help you. You can check us out at andasset.com. We have links down in the description where you can get the book, you can watch different videos and learn more. We just appreciate you. We appreciate if you give this video a like, give us a comment, and share this with people that need to see this content.